Oh, yeah. Another month, another stocks to buy. It's something we love doing here every single month. I got stocks for you I think are undervalued compared to the general market. I got 4 here for you today that I think are no-brainers to add to the portfolio if you don't have them in there already. And maybe add more if you want to. So, we're going to rock it today. Try to do these every month. It's harder and harder to find as really the general market is seeming to sort of record highs, and it really is. So it's hard to find these plays, but I got them for you. I do the research for you. Don't worry. We're going to start out here with one that has been on the list for quite some time, frankly, because this is still a great value play in my opinion. It's going to be Apple. That's right. None other than Apple. One reason that solidified it on my list would be the performance from the last earnings. You can tell when we saw the earnings drop Tuesday. The stock's down nearly 3% from that earnings. And we'll get into that earnings in just a little bit. So, and I completely disagree with the reaction. So, you look at the stock's performance year to date, up 11.8, actually higher than most of the market as a whole, frankly. In the past year, up 50%. Great performance, but not crazy when you look long term. Let's look at what the stock has to offer. So you got to consider this as a stock trading at a market cap of $2.4 trillion. Seems crazy. Highest valued company in the world, none other than Apple. I think there's reasons why it's valued so high. I mean, we're not going to disagree here. What I love looking at here, which I think is crazy, you look at some of the other valuation metrics here, a 28.3 trailing PE ratio and a 26.7 forward PE ratio. That's insane. So just to put that into perspective, because I think it's worth mentioning, the market as a whole, the S&P 500 is trading at a PE ratio right now of 34. And Apple, the largest company in the world, is trading at a market cap or a trailing PE ratio here of 28. So this is already valued lower than the entire market somehow, when this is the premier flagship company, frankly, of the world. I think it's crazy. Price to expected growth rate here at 2.21 is not crazy at all. Then we take a peek at the revenue. I think it's worth mentioning because you see a company trading at a market cap of $2.4 trillion. You wonder how that's possible. Well, in the trailing 12 months, this company has made $347 billion. That's a whole lot of money. And you put in that into perspective to the $2.4 trillion, that's not all that crazy. Really isn't. We're talking about really around 7 times the value there. 7 times that revenue is putting you right around that market cap, which anything under 10 in my perspective is not by any means bad. And I think this is a company that warrants a little bit larger one. If you can see the growth we've seen over the last year, look at September of 2020 and the 274 billion and trailing 12 months now, because there's been such a significant couple quarters here. 347 billion. The growth is massive. This is a company that's not stopping the growth rates, and I love to see it. What do I like about Apple? There's a lot. Obviously, Apple's got Mac. They've got iPad, iPhone, Apple Watch, Apple TV, Apple Music. So what do I like a whole lot about this company? Well, Mac and iPad aren't necessarily I'm not the biggest fan of those segments really for this company, because they're not the big growth segments. Where we see big growth and what's been continued to show great strength, and I've told you to look at it, is iPhone. Analysts have consistently underwhelmed the impact of iPhone on this company. Obviously the largest segment, but analysts continuously, and you know it, everyone that follows the stock knows, during the earnings cycle, analysts say, expect really weak iPhone data. It's going to be terrible. The sales are bad. It's just not true, frankly. I call them out every time, and I'm right every time. Apple Watch. I love Apple Watch. This is the #1 wearable company in the world, and it will continue to be. The great thing with Apple Watch is they're able to turn this into a health play as well, as it tracks and keeps your data as far as heart rate, steps, everything from that manner. So Apple Watch has great opportunities beyond that, on top of just being a nice mobile device you can use really for things from text to phone calls. So Apple TV and music, lump those in obviously too. Apple TV, obviously they're going to say they've been nominated for Emmys, Grammys, whatever you call them. Garbage, fake awards that are paid for, if we're being honest. But still, they have some shows on there, obviously worth mentioning, and subscription services are key right now, and that's why I like services as a great segment for Apple. They've been growing significantly. And how can I show you that? Well, let's look at that earnings I talked about before. Why should this stock be down from this? Just take a look. We're talking about a company that beat on an EPS standpoint by 29 cents and a company that beat on a revenue standpoint by nearly $8 billion over estimates. A growth of 34 or 36% year over year. iPhone revenue came in nearly $40 billion in iPhone revenue compared to a consensus of 34.5. That's a massive, massive smash. Mac beat, iPad beat. Again, not the main segments. Wearables, which I like more, beat by $1 billion. And services here, which is going over time to become their largest segment. It takes time to get there. $17.4 billion, over $1 billion over the consensus. So this is really a section they didn't have 5+ years ago, really. That's what's crazy. This is a new segment, just adding another wrinkle to their business. The company's massive in what it owns. That's why I like Apple. So I think this is a great play. They also pay a small dividend. They've been raising since 2009. So it's a good play. Close to 0.6% yield. Nothing crazy, but it pays you a dividend as well. And I think there will be plenty of capital appreciation to go over the next 5 to 10 years holding Apple. My next stock, it's a company I really like, and I've kind of been selling it for a hot minute. Ford stock. Why have I been selling it? Well, I think there's many reasons. You look at the stock now already performing pretty poorly today. But year-to-date, performance has been nice, 64.96%. That's incredible year-to-date performance, outpacing the market by quite a bit. But if you look in the last 5 years, this is why I like the stock. There's been no movement, nothing but downward movement from 2016 to 2020. Then we finally, after the big dip down, around the $4 range. Trust me, I was telling you to buy this thing at the $7 range, and it kept going down, I was telling you to buy around here because I felt great. Felt great at the $4 range, and I definitely picked up more. And the stock's really tripled since their lows, so that's what's crazy. 52-week low of $6.41. Crazy to see that. So why do I like Ford so much? You look at the stock itself and the valuation of it. That's what I love about it. $55 billion market cap, yet they have an enterprise value of $162.9 billion. So this business, frankly, is worth $162.9 billion. Yet they're trading at a valuation of $55 billion. One third of that. I find that a little egregious. And then we go into other metrics. You look at the trailing P/E ratio of this company, 13.9. That's incredible. That's incredibly cheap. And an 11.68 Ford P/E. And I bring back again, the market's trading at a 34 P/E ratio, and Ford's trading at a less than 14. Sub 14. Price to expected growth 0.23, ridiculously cheap, and price to sales at 0.43. Ridiculously cheap. And again, you see that with this enterprise value and market cap. We go into the revenue, and you can see that being the case. Trailing 12 months here, $129 billion in revenue. $129 billion. So, $129 billion in revenue, trading as if they're making $55 billion, and that's not including all of their business. I think that's pretty crazy in my perspective. So this stock is valued extremely cheap. Now you do take a comparison from 2019 when they made $155 billion. Obviously it's down. 2020 was a weak year for many reasons. The main core of those reasons being, shut down. I mean, let's be clear. These traditional automakers struggled last year. They really did. Factories were shut down. They weren't able to produce. Now, this year there are some issues with chip shortages and production, but there are great news data. I don't know what necessarily to say about that, but there's great information coming out saying that we're nearing the end of this chip shortage. We'll be there. Ford, what do I like so much about Ford? Well, obviously featured on your left here is the Ford Lightning, my favorite thing. Look at this, Ford Lightning. This is the future of the company. Electrification is massive. This will be the number one selling electric truck, in my opinion, for years. They're the number one selling traditional truck with the Ford F-150. And now the Ford F-150 Lightning is going to be doing just that. It's a great vehicle. If you haven't seen specs on this vehicle, you should. Definitely look at reviews. People are loving this vehicle because it's fantastic. And once, obviously, it comes to consumers, people will be buying the heck out of it. One thing you need to note, it's already got nearly 200,000 reservations, or over 200,000 reservations, and a majority of those coming from people who are new to the brand. That's what I really like about this. So you will still have your traditional truck owners that are sticking with the Ford F-150 brand, but this opens up the door for an entirely new audience who want to get in the electric game, and they know a brand like Ford with the F-150 is a very reliable truck. It's fantastic. So they want to get in on that name brand, but they don't want to be in a traditional IC vehicle. They want to be in an electric vehicle. We also have the Mustang Mach-E, which has actually been performing very well for a car that I think is pretty ugly just due to it being on the Mustang brand. If it wasn't for the Mustang branding, I think this thing would be a great looking car, but the Mustang branding ruins it a little bit. Sales have been good on the Mach-E. They really have. People have been digging this vehicle. We'll see when deliveries roll out, but people have been digging it according to their sales data, so it's what I like to see. What else do I really like about Ford? There's one other thing I really like about it, and it's going to be the 2022 Maverick. It's a very cheap vehicle. It's a cheap truck option starting at $20,000. I like it a lot. You look at the electrification. Again, this is where the future comes in. All electric Lightning, that's going to be massive. When they get into the electric work van, transit van, work vehicles being all electric will be huge too once they get into that game, which they will. They'll get into an all electric van, which will be massive because a lot of people use Ford vans for their work vans for sure. The E-Transit's a massive player in the game. So and then I wanted to show the overall auto market because I think it's worth mentioning. So far, obviously last year was a dip. You can see 2020 there was a dip, which is why their sales were down last year, down around 15% or 16% really. So this year, this is based through June, already 8.3, and this is just U.S. numbers, by the way, million vehicles sold. What's going to be fantastic here, 8.3 million vehicles sold. This is halfway through the year. So by all estimations, and typically you can look down here and look when more vehicles are sold. There's obviously usually a dip in August, September, October, and we typically will see a return to form. That was really just in the 2000 or the recession era, so let's forget about that. But if you look historically, let's look at the 2018 numbers. You look all the way down the line, pretty consistent numbers. Hot months in August, and obviously December being the top month. These people apparently are rich enough to buy vehicles for their significant others or for themselves for Christmas. I don't know how you do that, but just based off of that sales data alone, we should see likely a 17 billion vehicle year, even with a chip shortage. So I feel very good about this. And recovery is there. So this is going to be a company recovering traditional numbers and potentially going beyond that once they get into the electrification game next year. So this is a long-term hold. I love it a lot. My next stock is Walmart. I'm going with some very traditional companies here you all know of, but these are the ones that are getting left behind right now in the whole market. So why do I like Walmart? Obviously, it's seen some favorable performance in the last year, but if you look year to date, down 2.5%. The last year up 9.78, pretty weak. But in the last 5 years up 93.66. This is a stock that hasn't performed incredibly beyond really the post dip numbers. But compared to the general market, this thing's not gone up nearly as much as you might expect. And why do I say not as much as you might expect? Well, you look at the valuation metrics here, trading at a market cap of $398 billion. Not that expensive. Again, we'll look at the revenue to see what that lines up to, but trailing PE ratio of 32.9. It's a little bit high, frankly, just because earnings were impacted by last year due to increased expenses. But where you see the difference here comes the forward PE ratio of 24.75. Incredibly cheap, all things considered, but that's just the history of Walmart stock. They always trade cheap. It's just what they do. It's all they know is trading cheap compared to the general market. But here you go. Price to sales of 0.72 is darn cheap. We look at the revenue of this company, trailing 12 month. It's been a fantastic year. Look at 2020. Start of 2020 here. Not crazy. This is obviously in trailing 12 months standpoint. $523 billion. And then you look into 2021's full year. $559 billion. This is a company that wasn't growing sales by that significant, and they just boomed it by $40 billion in a year. That's the impact of what last year was able to do for e-commerce and just getting people spending money. So that's crazy. And trailing 12 months still up. We like to see it. We like to party. Net income also growing as well, by the way. Just throwing that one out there. But so if you look at that again, $560 billion in revenue, trading at $398 billion in market cap. That's cheap. I mean, it's cheap. It's undervalued. What can I say? Walmart, obviously, we know Walmart. Everything they sell. One thing I want to point out for Walmart. Excuse me. This is L. Oh no. I would never want to shove an L up my hoo-ha. It's not going to get out. But what I like about Walmart is the fact that they've initiated this Walmart Plus program. So this is entirely a direct competitor to none other than Amazon Prime. We're not shocked about it. We knew they were going to get in the game. So what are the benefits of this? Obviously, $12.95 a month or $98 a year. Pretty in line with Prime. So free shipping no matter what. Typically there's an order minimum. Usually it's around $35, I'm pretty sure, on Walmart's website to get free shipping. But now you can get free shipping with no minimum. They can deliver to your house, which is pretty significant. Same day delivery could be massive. And you're not paying a premium for it, obviously. Cheaper pharmacy products, baby. Cheaper prescriptions. Save money on gas at Sam's Club fuel centers, as well as Walmart and Murphy stations, as well as access to the Scan and Go app, which is pretty nice. The concern here obviously is going to be in theft, right? This is a service that allows people to check out everything on their phone, and then they get checked as they go through the register too. But they get to scan everything as they put in their cart. It's a lot quicker of a process. You don't really have to deal with people as much. It's what I like to see. So definitely fantastic. This is going to be a great program for them in the coming future. It just adds another wrinkle onto their business, another source of revenue that they can make. Because they're not only are they going to get revenue from the products they sell, they're still going to get this additional revenue now from having a subscription service. So that's what I like about it. It's a great thing. And you can't mention Walmart without the dividend. They've grown the dividend. Get this pop up out of here. I'm going to shove an L up your face. 47 years of dividend growth. Fantastic. This is a company that's obviously freaking champion of the dividends, right? They love paying. They pay quarterly. Growing for 47 years right now, yielding 1.55%, pretty low, and a payout ratio of 36 is pretty low, so they're going to continue to grow this. That's what I got for Walmart. My last one is a spec play, not necessarily value play, but there's value to be had in it, okay? New Age Incorporated. One that I've talked about before for sure. A company that's gone a big transition last year. By all means. You look at the performance of the stock, and it's been abysmal, down 28% year-to-date. The last year down 19.8%, and barely up in the last 5 years. They've had peaks. They've had many valleys. So look at the valuation of this company. $271 million market cap. But again, you need to mention they're not profitable, so keep that in the PE ratio standpoint. Not profitable. At one point they were planning on being, but due to these acquisitions, they're not. price to sales at 0.62 is something I like to see. No, I got hiccups out of nowhere. But the revenue of this company, dirt cheap, by the way. Dirt cheap, by the way. I mean, what can we say here? $341 million. But trading at $271 million. So there's not much revenue to be had in this company. Obviously, it's sub-billion dollar. But you see where the growth is coming. 2018, $52 million. 2019, $253 million. Then $279. Now $341. The growth has been significant, and really it's because of a new brand merger that they've been able to do. Typically, this company was a company focused solely on the beverage segment. Now they have a lot of different products. They've partnered with 5 different companies here. Alvin and Valliance, Eric's, Limu, Mavi, Zenoa, and Noni. But you can go into all these things, and they'll take you to their websites on the different products they sell. But really, the main core focus of this business, New Age, it kind of comes in the name. They're focused on healthy products, whether it be from skincare, personal care, drinking. They're focused on organic product, and I think it's, from my perspective, just a company that's somewhat of a company of the future. And due to this acquisition with this merger, they've really expanded their business from just a beverage company. Now they have segments all over the place. The beauty segment's massive for them. Vitamins. I mean, they've got it all now. So that's what I really like about this company. Those are your stocks to buy: Apple, Ford, Walmart, New Age. New Age, again, a long-term play. These are all long-term plays in my opinion, but that's what I got for you, and I hope you have a great day.